have two market maestros with us today, and we are pleased to have them here so that they can help us decode the market dynamics today. Thanks for making time. Thank you, Devina ma'am. Thank you, Sanjoy sir. To begin with, the FIIs have been offloading in the secondary market, yet they've made substantial anchor investments in the IPOs. So does it mean that they are temporarily fleeing India and staying invested in India in the long run? What are the factors at play? Do you want to go first, Devina ma'am?
So I think this is surprising. I can't fathom why they would do such a thing, because IPOs typically tend to be more pricey. And they have much less trading history, they have much less sort of clarity in terms of how those businesses will evolve and so on. And typically the IPO investor is at a huge handicap to an investor who is investing in an established company with a long track record. And I would not describe FIIs as fleeing this country. I think there's a lot of hyperbole about, the brave, wonderful domestic retail investor and the domestic institution and the bad, villainous FII. I just think we need to have more diversity in terms of the people who invest in this country, because, diversity of opinion, heterogeneity is what really leads to great markets, healthy markets. So for me, I don't know the answer to the question that you asked, but I would say that we need to move beyond this us versus them approach. I don't think it's productive for anybody. And I think people are entitled to sell when they think, markets are expensive, when there are risks that they don't want to take on, when they feel anxious about, what is changing at the margin. So I don't think selling is a crime and buying is an act of confidence. If you're an investor, you just need to behave rationally.
And I would like to really question the question itself, that why do we want to spend time and energy trying to focus on what FIIs are doing and what they will do? For a large part of my career, they were my clients, and this is a disparate group of institutions. And also, if you look at from their point of view, for example, 2010 to 2020, the Indian market barely gave any return at all in dollar terms. So, but the more fundamental question is that what is the reasoning behind this question? And the reasoning is that if FIIs sell, the market will go down. If FIIs buy, the market goes up. That's why we spend time and energy analyzing this question. But does that hold in the first place? So I have, in my book also, I've written a chapter that it takes me back to my school days when my maths teacher used to say that, every step that you're writing in solving anything, does the first step actually imply the second, and does the second imply the third? So, if you look at the long term, yes, this time it so happened that the FIIs sold and the market also fell. But if you look at long-term data, there is no correlation. And I have been there from the beginning. In fact, the reason I started this business was because the market was open to FIIs in Dr. Manmohan Singh's, I think, 92 budget. And let's look at the data right at the beginning. The FIIs really started investing in India from 1994. So at that time, no Indian mutual fund existed. There wasn't retail participation to anywhere this kind of scale. So you would think these new billions of dollars coming into India will completely drive up the market. But what happened? 1994 to 2003 is the only 9-year period in India's history when the net return from the index was zero over 9 years. So obviously that didn't move the needle. So that's why, and even on a month-to-month basis in the beginning, we used to track it, that how much impact does it have on the markets, and there was none fact, in the beginning, FIIs were always net buyers every month. And there was 1 month when they turned net sellers. I think it was November 98 or November 99. And that month, the market went up. So it's, I think, a fool's errand in the first place to try to second guess what they will do. I don't think it's worth spending a lot of time and energy trying to do that. So I mean, this might be net just decisions made on the margin by certain funds, which has resulted in this thing that they've invested more in IPOs than in public markets. And I agree with Sanjoy that typically the risk is higher in the IPOs, and the knowledge you have is less. And especially in this bull run, the pricing also went completely haywire.
Devina ma'am, just to understand a little more, do you think FII selling will continue for a long time, considering that right now it's absorbed by the DII and retail inflows?
So that's the whole point, Deepthi. I'm saying that there's no point trying to guess what they will do, because that, I mean, the implicit in that question is that if FIIs sell, the market falls, and FII buy, the market goes up, which doesn't hold. So let's focus on what we want to do in the markets rather than trying to guess what somebody else will do in the markets. What is the rational thing to do in the markets? That's the question.
Sanjoy sir, any views?
I'm completely in agreement with Devina. Nothing to add.
With market corrections underway, we are seeing bursts of buying activity intermittently. Also, with the recessionary fear in the US, there are veterans who are favoring Indian equities at this point in time. So what's your perspective on that?
So, first of all, many times narratives follow what is happening in the markets. Like if you're talking that India is doing better, but I mean, just a couple of months ago, there was all this ho-halla about that consumption is slowing. But consumption actually never did slow in this financial year. The consumption slowdown happened in 23-24, which I think in the last Mint, the same conference had spoken about, that consumption growth was at a 21-year low. But at that time, nobody focused on it because the markets were doing well. When markets started to falter, you said it is because of consumption. But if you really look at the data, this year private consumption in the GDP, if you look at the estimates, is supposed to accelerate from about 4% to 7.5%. As far as the US is concerned, I mean, there is obviously, uncertainty has gone through the roof with Mr. Trump coming in, which is what I had expected and written about in November when he won, that there is little predictability to what will happen. I mean, all the people who are saying that this will happen to currency market, that will happen to stock market and bond market, I mean, what are they smoking? Because you don't know what the guy will do in the first place, so how are you so confident of second order and third order effects? And which is what you are seeing now playing out in real time. And compounded, if you had to compound uncertainty, couldn't have done better than marry Trump to Musk. But, I mean, as of now, US is not close to a recession, but of course, consumer confidence is faltering because no one likes uncertainty, that every day you don't know what will happen. So my concerns are not so much to do with US recession. My concerns actually, if you talk the global issues, are more to do with the fact that you have changed all the assumptions that we had taken for granted for a good 80 years. So Trump has taken a wrecking ball to multilateral anything, WTO, WHO, NATO, UN, World Bank, everything he has a problem with. Saying EU was set up to con the US and so on. So suddenly, yesterday I read this news report where EU says, told its citizens that stockpile essentials for 72 hours in case of any war or any geopolitical upheaval. I mean, who would have thought even 3 months ago that something like this could happen? So those are more my concerns. I don't think US is exactly going into a recession immediately or anything like that.
It's what Devina said, I think, that, basically investors hate uncertainty. And right now is a very uncertain period. The reason I think to be careful now is that there simply isn't a margin of safety. You know, markets are pretty reasonably valued, at least in India. So also in the US, by the way. In the US, they're just a bit off their lifetime highs. And I've often heard this argument trotted out that the Indian market has fallen 10% or 15%, and now we are at average. You know, earlier it was 1 sigma above. I mean, common sense would suggest that markets can go to minus 1 sigma. If they ruled at +1 and +1.5 sigma for so long, why not minus 1 sigma? And that minus 1 sigma typically tends to happen when people don't know how to respond to what they see as bad news. So I think this is a time to be careful. And if, you know, as I've always said, I love a good crisis. So if markets fall significantly from here, yeah, sure. This country isn't going to change negatively in the next 5, 7, 10 years. So if prices are in your favor because of a meaningful drop in, you know, share prices, yeah, then it would be a great time to invest. But the moment clearly to dive headlong into markets is not now.
You said that the value, you think that Indian market is reasonably valued. Does that mean that India Inc. is not facing any challenges structurally?
This word always confuses me. Structurally, it's a new word in the lexicon of investors. I thought investing was pretty damn simple without so much, you know, hoopla about structural, non-structural, cyclical, seasonal. I think all countries face structural challenges simply because the future is uncertain. I'll give you a simple example. I'm not trying to be, you know, facile or, you know, take this lightly. But what will AI do to how companies function in the next 10 years? I don't know whether people have clear answers, but I think it will make an impact. And I think, you know, the way certain industries function and the way in which they earn their profits today will change dramatically. So, yeah, I think the economic environment, the business environment in India is a positive environment. That's not to say that we don't have some problems which we need to get around. And whether they are structural or not, I've never understood, but we do have problems. There are not too many problems, but there are definitely problems. And one, I think, which many people have spoken about is credit growth in the Indian banking system. Because at the end of the day, growth requires resources, financial resources, and a large part of that resources comes from credit growth from various different places. And to that extent, that's one of the things that certainly we face at the moment. So, yeah, we do have some structural problem, but it's not the end of the world. It's not as if, you know, we're going to fade and go away. No.
I'd like to add something to this, which is that often when we are talking countries, we mix up economies and markets, which are actually two completely different things. I mean, US may not have a clear and present danger of recession immediately, but are the US markets, how they are going to perform is a totally different question. And remember, US has been a huge outperformer in the globe for the last 10, 12 years. And for a time, I had been watching that sometime it would change. And it still looked, maybe that time is some time away, but Trump's coming has really, to my mind, hastening the end of the outperformance of the US market, probably. I mean, one is watching, but that hypothesis is becoming stronger. And also, I mean, in terms of the disconnect between the economy and the markets, I cannot give a better example than China, where the Chinese market made it high in 2007. And thereafter, now the GDP has gone up nearly 7 times without the market decisively taking out that high. So it can be to that extent, the disconnect can be so much. For India, just one other data point, that 2010 to 20 was a very low return period for the Indian market. We think that equity markets in India have given 15-16%, which is the long-term average. But decade to decade, deviation has been very high. So, of course, 1980s decade was 21%, then then 17, and the 10 to 20 decade was only some 8.5, 8.7, 8.8%, which was barely above fixed deposit rates, because remember those days fixed deposit rates were around 8%. So that's what created the room for that bull market that we have seen. And I mean, my own advice is that whatever is your equity allocation, it is not time to really sit out of the market, but may not be in exactly where you are invested today. So that's the other point, that a stock or a strategy which is down 40%, 50%, 70% might still be a sell. So you don't have to make it back in the same stocks, because this is also the nature of markets, that especially after mad bull runs where everything did well, that after the fall, when the next rise comes, it may not be the same stocks at all. So, that would be that, to be in a steadier portfolio. But sitting out of the market right now, that wouldn't be my advice. On the other hand, I do see that there are problems on the economic front. The biggest one being that are you missing the bus on your demographic dividend? That's the biggest one. That demographic dividend, we all think means having a lot of people of working age, which we do have, but we are not able to find jobs for those people. So demographic dividend is the percentage of people in working age into those that are employed into the productivity. So we are like faltering big time on the second one, which is getting employment for people. But as I said, markets and economies don't have a one-to-one correlation on a real-time basis.
Devina ma'am, we are nearly 4 years into the PLI schemes and the China plus one narrative. And the GDP, manufacturing share in the India's GDP remains stuck at more or less the same level. So, do you think that's a big concern for markets?
Again, markets, not all of your markets is manufacturing in the first place. And manufacturing in the economy includes a lot of unlisted business. But what you are saying was, again, last year also I had highlighted this concern, that it is not just stagnated, it has come down. So manufacturing as a percentage of GDP last year was about 13.5. Somebody on social media told me it's 12.5. I haven't checked that number yet. But even that 13.5, last time it was this low, can you guess when that was? It was in 1969. So after 50 years, you have manufacturing as that smaller portion of GDP. And we were at 17.5 for, I think, from about 2008 to 14, 15. Barring 1 year, we were at 17.5. So, I mean, and my question with a lot of incentive schemes, and PLI being an example of that, is that we do not always align the objectives and the incentives. So what were we trying to achieve with this PLI scheme? If it was employment, and this I've written about also, that you were giving these huge chunky subsidies to, let's say, a semiconductor maker who's going to employ 4,000 or 5,000 people. So was that the best use of that money? And just as we had this corporate tax cut a few years ago, and if you look at the high corporate tax paying companies, they are what? They are banks, they are PSUs, they are MNCs, usually in FMCG and that kind of thing. None of them is going to put that tax saving into capex. So what were you trying to achieve? Were you trying to achieve investment? Were you trying to achieve employment? For both of that incentive didn't work. So I think there's an issue with thinking through what we are trying to achieve through incentives, and which is why the incentives are, I mean, we thought incentive PLI was supposed to increase manufacturing, was supposed to increase employment, but probably that was not targeted properly enough. That's my take.
Any thoughts, Sanjay sir?
I think two things. Well, the one thing that Devina said is very relevant. We seem to have forgotten Adam Smith in this country. So it would help policymakers if they remembered what Adam Smith said. Just because other countries make semiconductors doesn't mean we have to make them. That's point number one. Point number two, all notes count the same. So how does it matter? Whether you make it from manufacturing, or you make it from services, or you make it from agriculture. Because I think the interesting thing is it has to add up to 100. that gross number doesn't change. So manufacturing loss is someone else's gain. So figure out where it's gone and see if you have opportunities there. You don't have to fret about, the total can never be 110. That's the only thing I can tell you. Once that idea is deeply embedded in your head, I don't think these issues count too much. All nodes count the same. Too much macro thinking in investing is destructive. You just need to figure out 2 or 3 things: interest rates, inflation, money supply. Beyond that, it's certainly beyond my pay grade. And I venture to add, it's beyond the pay grade of 99.9% of investors, not just mine.
What about the art of selling? You've often emphasized on that. So, when is the right time for an investor to sell? Some sell too early, for the others it's late.
It's purely, I think, a combination of a couple of things. One, your ability to understand yourself. So I think most investors, especially when they start out, are overwhelmed by greed. They just think, they haven't heard the story of Jack and the Beanstalk, obviously. So for them, the beanstalk grows all the way to heaven. But sadly, it doesn't. So that's point one. The second thing about selling is, I think, you've got to recognize the nature, the history of how companies have traded. It's an important indicator. If you look at stock market history, not just in India, but if you look at stock market history across the world and for similar businesses, it'll give you tremendous clues. If you look at the Nifty 50 in America in the mid-60s, it tells you a lot about how companies, when there's excessive enthusiasm, how they get valued. Second thing I think about selling, which people typically tend to disregard, is you own a business. The business has a certain value. You're a fractional owner. Would you pay 100%? Suppose you weren't a fractional owner. Suppose magically you woke up in the morning and God said, I'm sending you a check. Amount unknown. You just put the amount yourself. Would you own 100% of that company that you own? And feel happy and sleep well at night? And if the answer is no, then you've got to ask yourself, what am I doing? Why am I not thinking about selling this company? It's as simple as that. Actually, investing is not a business that attracts people with high IQs. Buffett has said this. You're lucky if you go beyond 110. With no offense to Devina, it certainly applies to me. Devina's credentials academically are outstanding. Truly, truly outstanding. So it doesn't apply to her. But for the vast majority of people in the Indian stock market, you won't find IQs beyond 110. And that's not disparaging. Just keep it simple. If it's supremely expensive and out of whack with how such businesses trade around the world, sell. And selling is not an act of infidelity. You can buy something again with it. You got to keep your wits about you. You got to get less greedy. You got to remember, what history tells you. And most importantly, not have, morality get into selling. If you mix up morality and selling, you have a serious problem.
In fact, let me add to that. Instead of morality, I'd say that don't fall in love with stocks. And I actually had this conversation with a fund manager who used to be a client back then. I said, don't fall in love with your stocks. And he looked up like this and said, "Pyar to ho hi jata hai." So don't do that. So love is for your family and friends. Don't fall in love with stocks. And as I said, you don't have to make it up in the same stock. And I totally agree with Sanjoy that you should look at what happens globally, but it's not easy for everybody to do it. I remember about 15 years ago going around to all the fund houses explaining that this is the trajectory of how telecom businesses are valued around the world and how the PE is reduced, because telecom is a business which has a natural limit to how much the subscriber base can be. Because it cannot grow infinitely. It is not like other goods where you can keep saying the growth will continue. This is a finite number of people. And therefore that trajectory all around the world had followed that, but nobody wanted to listen.
Actually, Devina, sorry to interrupt.
Yeah.
But in India, people would not believe you. You know why? I see so many people in our own business with 3 mobile phones.
Yeah, but
so
that's
you think it can grow to infinity actually when you see these guys.
Okay. And for selling, I mean, my very simple formula is that when you buy something, I'm saying that for the lay person, is that if you buy something at 50, don't tell yourself that I'll sell when it is 100 or 150, because that's the way you'll miss out on multi-baggers. But always put a stop loss and put a trailing stop loss. So let us, I mean, for the sake of argument, suppose you put a 25% stop loss. It doesn't mean that if you buy something at 50, the stop loss forever is at 37.5. If it goes to 100, comes down to 80, you don't sell. Goes to 150, 200, don't sell. But from 200, it comes down to 150, 25% down from the high, then you sell. I mean, that's a simplistic formula, but for people who can't do anything much more than that, it's a reasonable formula to follow. Of course, as a professional, you might do other things and you might sometimes sell something because you have better opportunities. And so on. But the point is to, as far as possible, to let your winners run and limit your losses. I mean, that's the basic principle. And this is the way to operationalize that principle. But the thing is that don't say that, okay, jab market girega, stock girega, then I'll think about what to do. Because at that time you will freeze. So you have to put all this discipline in place to start with. I always say the best thing you can do for your portfolio when making an investment is tell yourself, I may be making a mistake. Because I can tell you a reasonable percentage of your investments are going to go wrong. They are not going to do what you thought they would do because, as Sanjoy said, you don't know the future. And investing is about the future. So if you, so you always have to imagine that the outcomes will not be and may not be the way you are imagining themselves that to be today.
Can I add one thing? Sure. Because it's quite interesting. Again, taking a cue from Devina. See, this is an area where, I mean, if you bat at 55%, in other words, if 55% of your decisions are right, you will be like Don Bradman. Most people don't realize that. The professional fund managers bat at about 51.5. Superheroes are at 52.5. Most of us are at about 48. I am at about 45. So the important thing for those of us who are below 50, and this is another thing I'd like to add, don't overtrade. You're just enhancing the chances of going wrong. Think long and hard before you invest. Think about what you're buying. You own a business, but don't do this like as if you're visiting, the gaming table, the casinos every morning. That's not investing. We love to call that investing. That is not investing. Put in the effort. You won't have to worry so much about selling if you put in the effort before buying. Just figure out what you want to own, how well you understand it, the amount of, the clarity that you have about how things, nothing is certain, but about how things are likely to shape. And then, most important, and it was implicit in what she said, have patience. Nothing happens overnight. So, I think a lot of, this idea that Buffett had, only 20 stocks in a lifetime. I know none of us will ever do it, but it's a damn
he has not done it.
No, he hasn't done it, that's true.
I mean, he sells 85% of what he buys within 2 years, majority within 6 months, so he has not done it. I mean, and he says that in 70 years of my investing, only 10 or 12 decisions have made all the money. Yes.
Which is true for all of us.
Yes.
I don't think there's a single
but you do not know in advance. I mean, sometimes people tell me that, okay, you identified HDFC Bank in 1996 or Amazon in 2001. Now, tell us today's Amazon or HDFC Bank that I can buy for my baby and leave for 25 years. I said, nobody knows. Anybody who tells you they have this crystal ball on what a stock is going to do for 20 years is fooling you. Because no one in the world has had anything like that kind of track record where even 30% of their picks turned out to be multi-baggers. I mean, Rakesh Jhunjhunwala made all his money in CRISIL, Lupin, Titan, Did he know at the beginning? I mean, every time you would meet him, he would be talking of different stocks. He didn't know in the beginning that these would be the stocks, and these companies themselves went through so many ups and downs. I was reading this book on Titan called The Tanish Story, and so many times that jewelry business was on the verge of getting shut down because they made so many strategic errors along the way, or something changed in the regulations. So no one has this crystal ball. So you always have to buy a portfolio of stocks chosen carefully, and 25, 30 stocks you buy across sectors. Even then, 6 will turn out to be total duds. Some will give you reasonable returns, and if you are lucky, maybe 2 or 3 will be multi-baggers. So that's the ratio.
I think Devina is in a charitable mood. If you have only 6 duds, you're really smart.
At least, I would say that's what I said, at least.
Yeah. So, the other thing about, selling, which I think is very important, which people don't get, is you should only sell again when you have a clear idea in your head about 2 things: opportunity cost. Because when you sell, you're raising money and you have to know what you're going to do with that money and how you're going to deploy it going forward. So opportunity cost of selling is very, very important. If you don't have something better to deploy it in, and you own what you think is a really solid business, you can also wind up selling too early, as I've done in my life. And I was reminded of it when Devina spoke of HDFC Bank. I bought it in 95 and sold it in 95. Because I'd made 100% in 95. And look where that's got me. So, it's not, selling also has that element of thinking about what do I do, what's the opportunity cost. And the second thing about selling, which I think is, don't mix up selling with paying tax. This is a wonderfully Indian habit. People in India just have a total anathema to paying tax of any kind. If you have that, you will make serious mistakes with selling. I know lots and lots of people in this audience who won't put up their hand because they want to be dishonest, who would have sold before March 31st for tax losses or tax gains. You can harvest anything under the sun. You're not going to get a damn out of it. There are going to be no fruits and no joy. So please harvest when, you're going to get significant returns from it. In fact, tax harvesting creates tremendous psychological anomalies which other smart people can, take advantage of. So this idea that paying taxes is not a good thing also affects selling tremendously. And don't do it. That's a very easy one to control. Sell because it's right to sell in your head, not because you're trying to get smart.
Actually, a question that your discussion brings me to ask you, how important is diversification, considering within equity and across asset classes?
I'll finish this in 2 sentences. And my response is very trite, because millions of guys have said it before me, wiser people, far wiser than me. I heard a friend of mine say, diversification is the only free lunch in investing. And there's a semblance of sense in this one. Diversification in a situation where you don't know what's coming at you going forward just gives you that extra sort of cover. If you own, all 5 stocks in one business and something bad happens to that business when you wake up tomorrow morning, you can be crushed. Yeah? The second thing about diversification is, again, go back to history. And there are 1 or 2 exceptions, but look at the history of the concentrated investors. The guys who owned only 6, 7 stocks. I don't want to name people because they're much smarter than me, and I don't want to therefore seem that I'm, hindsight is always 20/20, so I don't want to do that. But there's a very famous Indian investor in the US. So with public money, he had a portfolio which owned just 7 and 8 stocks in his funds. And he went absolutely belly up in 2008. And he is supposed to be one of the great gods of investing today. Visits India often and dispenses wisdom on Indian stocks often, and he participates in chats like this often. So diversification for most of us with below 110 IQs is a great thing.
So, I mean, diversification, you mentioned all of that. Then, I mean, one is across asset classes. You must always invest across asset classes. People tell me, I'm 25, I'm in a good job, should I put 100% in equity? No, you should never put 100% in equity. So have equity, fixed income, gold, real estate you might anyway have because you own your home. I'm not a big votary of investing in real estate. And then diversify across geographies. Again, don't put all your money in India. I always give this number that when I started working, the dollar was 12 rupees. In the course of less than a career, we have a 90% depreciation. So don't forget that part, that you cannot make a 20, 30-year financial goal plan and forget this statistic. So have that within equity. Again, diversify across sectors. As Sanjoy said, that if you have 6 stocks in one sector, it is as good as holding one stock. So always diversify across sectors. And what diversification does, it is like tossing a coin. You know, investing is a game of luck and skill. Everything in life actually is a game of luck and skill. I can think of only chess, which is a game of skill alone. But if you toss a coin 10 times, you might get 8 heads or 9 heads. If you toss it 100 times, you'll be close to 50-50. So what diversification does is that if you buy a higher number of stocks, your final results are more predictable in the sense they will be closer to your skill level. You're reducing the luck element, you're increasing the skill element. That is what diversification does. It is not the magic that 50 stocks are better than 15 stocks, but that's the part that diversification does. But always consciously think through your asset allocation. And I always say in Google Maps, you don't just put the destination, you put the starting point. So first know where currently you are invested. What are all your assets and what are the loans against? So look at that and then think consciously about where you actually should be or want to be. And equity should be as a class, not I'm saying you have to hold the same stocks, but equity as a class should be money typically you do not need for 8 to 10 years. For what you need in that time frame, it should be in other assets.
One trivial addition, if I may, I know we've run out of time, but it's something that's very important in the current context, particularly in equity mutual funds. You know, nowadays I'm completely sort of amazed at the skill that Indian equity mutual fund managers have, because their portfolios have 283 stocks. There's a small cap fund, and one of the best performing small cap funds, by the way. Not to take away from that guy. I mean, his track record has been phenomenal in the last, the average mutual fund has 75, 80 stocks. Now, the one thing about diversification, that anything good in life, it can be taken to excess. And when you own such large number of stocks, you actually lose some of the benefits of diversification because there are what are called cancelling out effects. You know, the gains in, let's say XYZ will cancel out what you did in PQR. Second thing is very difficult to keep track of 85 stocks. It's unlikely that your 85th idea is as good as your first or second or third or fourth idea in terms of how much you thought about it. So diversification taken to excess is like my love for food. Taken to excess, it shows up.
So, I mean, that's why we use a system, because, I mean, I agree with you that you, as a person, you cannot keep track of that much, and that's why you need a system to do that. So that's why we switched. I mean, I actually started the PMS only after we had the system.
We can open the floor for questions. I think then that's a wrap. Thank you for making time.
Thank you very much for having us.
Let's have a huge round of applause for Devina Mehra, Founder, Chairperson, Managing Director, First Global, and Sanjay Bhattacharya, Managing Partner, Fortuna Capital. Deepthi, please present a token of our gratitude to both of our panelists. A conversation that all of us were so tuned into. Thank you very much.